start the recording. Okay, so yesterday we finished the evening by talking about what happens and how do I consolidate when I do not buy 100% of a company, but less than 100%, because as you remember, to control a company, it is not necessary to own 100%. We can also have 60% or anything below 100%. So then we need to do the purchase price allocation, so that doesn't change. But then there are two methods how to calculate the goodwill, the acquired goodwill method on the one hand, or the full goodwill method, either way. Okay, now let's try this on a case, which would be the exercise number 3. Here we go. Let me just put this on the next page so that we can better see. Okay. So we see here we have the balance sheet of the parent company. We have the balance sheet of the subsidiary. It's the same balance sheets as before. And we have the additional information about the subsidiary regarding the fair value of the equipment, which is 350, like in the previous example. And we have developed a brand name whose fair value is estimated at 100. So exactly the same thing as before in exercise number 2. But now what has changed is that here we assume that we acquired only 80% of the subsidiary, and we still paid 450 for that. And here in the balance sheet of the parent company, we see the investment at 450. Okay, so first requirement, well, prepare the consolidated balance sheet at the date of acquisition, applying both goodwill methods. Okay, so first thing we need to do is the purchase price allocation, of course. Well, so let's do this. Price allocation, and we will first use the acquired goodwill method. Okay, how do we do this? Well, we need to compare, as we said, the purchase price on the one hand minus the fair value of S. Okay, and the difference here would be the acquired goodwill. Okay, so the purchase price is 450. Okay, and the fair value of S, well, we do the same calculations as before. S has only one asset, which is an equipment. The fair value of the equipment is 350. Okay, S has also a brand name whose fair value is estimated at 100. So that also, sorry, that also counts. Excuse me, wrong typo. Okay. So plus 100. Okay, no other assets, and we need to deduct the liabilities. So here, once again, for the liabilities, we assume that book value equals fair value. But be cautious. In real life, that's not necessarily the case. So we need to fair value the whole balance sheet, assets and liabilities. And obviously, there can be differences between book values of liabilities and fair values. Okay, but here there isn't. So that means I need to deduct 40 in liabilities, which means basically that my fair value is 410, what we had before. But in the acquired goodwill method, I take the purchase price and I deduct the parent percentage of fair value. Okay, so here I calculated the fair value, which is 410. Okay, but in this example, we buy only 80%, and that means I paid basically 450 to buy 80% of this fair value. So 80% of the fair value, sorry, I have to check my solutions because I don't know this by heart. So the fair value of 80% of 410 equals 328. Okay, so basically 80% of the fair value equals 328. So the acquired goodwill, therefore, is 450 minus 328, which is 122. Okay. Question for the acquired goodwill method so far. Okay. Then let's do immediately the full goodwill method. Full goodwill method is the purchase price plus the fair value of non-controlling interest minus the fair value, and this time 100% of the fair value of the subsidiary. Okay. So we did already the calculations. The purchase price is 450. Now I need, obviously, as an extra information, additional information, I need the fair value of non-controlling interest. And here it's indicated in the exercise that we should assume a fair value of non-controlling interest of 100. Okay, so therefore I will add 100 to the purchase price. So that means here, hypothetically, this is like I paid 550 to acquire 100% of the company. Roughly, that's the idea, although it's not precisely that. And I will deduct the fair value of S. Well, the fair value, we have already calculated it, and it's 410. Okay, so I deduct this, which means here now I have a acquired goodwill of 140. Okay. All right, so acquired full goodwill is 140, acquired goodwill is 122. So as I said yesterday, of course, if I use sorry, can you hear me well? Because on my other screen it tells me there are audio problems. Can you hear me? Okay, good. So as we said yesterday, the full goodwill will always be higher than the acquired goodwill. Here we see this, there's a difference of 18. And that means the difference here of 18 basically is the goodwill that relates to non-controlling interest. Basically, that's the idea. Okay, so we did this analysis. That means now, as before, we need to set up the fair value of S balance sheet. That means here, well, we do the same as before. I have an original equipment value of 200, but now the fair value is 350. And therefore, I need to increase that. I need to recognize a brand name, and it has been valued at 100. And I need to balance all this by increasing equity and adding something like retained earnings, which will increase by 250. So once again, I add 250 on the asset side, 250 on the liability side. Okay, then we take these numbers and we add the parent company. So I will use that as a as always as a benchmark here. Right. Okay, so I set up the combined balance sheet. Okay, so for the subsidiary, I have an equipment of 350. For the parent company, I have an equipment of 240. So therefore, total equipment 590. We have a brand name, okay, and from the parent balance sheet, we have the investment in S. The amount is 450. Capital, we have, as always, 300 for the parent plus 100 for the subsidiary. Net income, we have 20 for the parent plus 60 at the date of acquisition for the subsidiary, and liabilities, we have 370 plus 40 in so 410. Okay, and then we do the eliminations. Okay, well, I will actually here, before I do that, introduce another one. Okay, so I need to delete, as always, my investment account. Okay, so let's do this. Delete it here. I need to delete. Now here we have to do this step by step. Okay, remember here we purchased 80%. That means in the first step, I will eliminate 80% of the capital. Okay, because I eliminate only the parent share. And I will eliminate 80% of the profit, the acquisition or the pre-acquisition profit. And here we have retained earnings of 250. And in the first step, I will eliminate just 80% of those 250. Only the parent share, only the parent share is eliminated in the first step against the investment. So when I do 80% of 100 plus 80% of 60 plus 80% of 250, if I add up all this, what do I get? Well, I get what we calculated here. That is 328. So basically, by deducting these amounts, I deduct 328. And since on the asset side, I deduct 450, there's a difference, of course, of 122. And the goodwill, the difference here relates to goodwill. Okay, so as we do always, I eliminate the investment and introduce goodwill. That means on the asset side, I take away 328. And in the three equity items, I take away also 328. So this is balanced and we are okay. All right, and in the last step now, we need to recognize non-controlling interest, because remember, we have 20% of other shareholders. Calculation of non-controlling interest is, at least in the acquired goodwill method, always easy, because you take just the equity, the fair value of equity of the subsidiary. So these are the three amounts, and 20% of that. Okay, so that means NCI here in this example is 100 plus the retained earnings of 250 times 20%, because we have 20% non-controlling interest. So basically it's 410. Now remember, we calculated this here. All this together is 410. So 20% of 410, which is 82. That means NCI is 82. And these corresponding amounts, the 20% of the three lines, well, they are taken out of the upper level. Okay, so I take 20% of 100. Okay, let me put this over here. 20% of 100. I take 20% of 60. Okay, and also here I take 20% of 150. So that means here, if I look now, the capital of the subsidiary is completely gone, has been eliminated. The acquisition profit is completely eliminated, and the retained earnings are completely eliminated, so that in the end, I have only the capital of the parent company, the profit of that, the retained earnings are 0, NCI, and so on. Okay. And therefore we are good. And I have on both sides of the balance sheet, I look at my solution, see that, well, here we go, the total, I have 812, sorry, that's 300. I have on both sides of the balance sheet 812. And then we are good. Okay. Do you have a question to this, to the acquired goodwill method, please? Anyone? Okay. No question. Then let's move on to the full goodwill method. Okay, so in the full goodwill method, we calculated the full goodwill. It's 140. That, of course, is an information we need to remember. And I need also to remember that the fair value of non-controlling interest is 100. Because here in the full goodwill method, the original NCI amount will not be calculated as here as a percentage, but will be set at 100. The first NCI value that needs to appear is actually the fair value of NCI. Okay, so in the full goodwill method, in the first step, I will fair value S. Okay, so we do the same thing, but here to change a little bit, but it doesn't really matter. I would also introduce already the goodwill that we have calculated, and the goodwill is 140, which means that in the retained earnings, there's not an increase of 250, but 390. Okay, so I do this here in the first step, and then based on this, once again, we set up. If I copy this, okay, we prepare combined balance sheet. That means equipment of 240 for the parent and 350 for the subsidiary. So 590 in total. We have the brand, we have goodwill already in the balance sheet, and we have the investment S at 450. We have capital of the parent plus of the subsidiary. We have profit of the parent plus the subsidiary. We have the retained earnings and liabilities. We have 370 for the parent plus 40, so 410 in total. Okay, and I need a specific line. So same thing, what we do, we eliminate the investment. Okay, I can do that. And I eliminate directly all of the capital of the subsidiary, like we did previously, all of the profit pre-acquisition of the subsidiary, okay, and all of, sorry, and all of the retained earnings of the subsidiary. Okay, that means here I eliminate 550, as you can see, 160 plus 390. So in total on the equity and liability side, I delete 550. On the asset side, I delete only 450. So there's a difference of 100, and this difference is non-controlling interest. So I will, in the same step, introduce non-controlling interest, and that means now on a net basis I eliminate 450 and on the right hand side and 450 on the left hand side. And then we are done. So we have a total balance sheet of 830 here. And here my final capital is 30, final profit is 20, NCI, and it's the same thing. We have 830 as a consolidated balance sheet, goodwill method. Okay. Question to that, please. Here we have console balance sheet, add goodwill method. Okay, when I compare the numbers, we see that the equipment value is the same, the brand value is the same. Well, all the asset values will be the same in the two methods except for goodwill. So full goodwill is 140, acquired goodwill or partial goodwill is only 122. That's where we have a difference. These are the two numbers with a difference. The capital is the same, net income is the same, total liabilities is the same, and where we have a difference is NCI, because in the full goodwill setting, NCI are higher because the NCI value includes the part of goodwill that relates to NCI. Okay. Any questions, please? So just a recommendation, maybe before you have a question eventually. Just a recommendation is that you should do this on a step-by-step basis, as I showed you here. So it means first revalue the balance sheet of S, add up all the numbers, and then do the eliminations. Many times what students do, they do everything in one step because, well, here, or the first exercises are rather simple, and then maybe you can all do this in one step. But more complex cases, that will not work. There will be omissions, there will be mistakes, etc. So therefore, I highly recommend that you follow this step-by-step logic. Otherwise, you may get lost. Okay. Questions? No questions? We're all good? Okay. Then we continue. And as before, now we are on December 31st of year N, so 9 months after the acquisition. Okay, and of course, once again, we need to consolidate the subsidiary. So here we go again. That means, once again, I need to fair value balance sheet of S. So here, by the way, on December 31st, we only do the acquired goodwill method, not both. Now you know how it works. It doesn't really make a difference. So either way, I need to fair value again. Remember, when I fair valued S in April, I did not modify the official balance sheet. So it means, well, in the official balance sheet of S, the still missing is the valuation difference that I had last time. So the 150, and I need to add it back. What is also missing in the balance sheet is the brand name of the subsidiary. So I need to add, once again, the brand name for 100. So exactly the same. And we have retained earnings to make the balance sheet equal. And we add 250 to the retained earnings. So that my final balance sheet at fair value is, of course, still equal. Okay, what do I need to do next, please? Someone? What do I need to do next? Yes, Dong, combine them. But am I finished with the fair value of S as of December 31st? Is that really the fair value of S at the end of the year? Exactly. We need to do a depreciation, or in general, we have all those valuation differences, etc. So here in the equipment, in the brand name, and we need to do a follow-up evaluation. So for the brand name impairment test, okay, here's no indication, so there's nothing to do. And for the equipment, I need to depreciate, okay? And remember, we calculated already the depreciation. This does not change. So if I buy 80% of a company or 100%, since I include 100% of the assets, liabilities of the subsidiary, well, everything is exactly as in a 100% case. So yesterday we calculated the depreciation as 1125. That means I need to deduct the same 1125. That means net income of the subsidiary from a group perspective is not 180, but the reduced amount of 168.25. Okay. Now I have the fair value of the subsidiary. Okay, then let's take this, use this as a basis, and now I prepare the combined balance sheet. Okay, so I have to check my solution because I don't remember the numbers. So here my equipment value for the subsidiary now is 348.75, and for the parent company at the end of the year is 360. So together that's 708.75. Okay, I have inventory. Okay, I have the brand name, I have cash, 40 for the subsidiary plus 80 for the parent, so 120 in total. Okay, and obviously we also need here the investment is accounted for as 450, as in the previous case. Okay, capital has not changed, 300 for the parent plus 100 for the subsidiary. Net income is 80 for the parent plus 68.25 for the subsidiary. And earnings 250, and liabilities is 510 plus in total 560. Okay, same thing. So I will eliminate the investment. Okay, so let's do that. On the one hand, then I need to eliminate so minus 80% of 100. 80% of 100. Here in the net income, I have to be careful because now I need to eliminate, obviously, 80% of the profit existed when I purchased the subsidiary. 80% of the profit that existed when I purchased the subsidiary is 80% of 60. Okay, so I keep the same numbers. Okay, and retained earnings, well, we have 250, and I will eliminate 80% of 250. These are the numbers at acquisition date. So we know that if I do all this, so if I take 80% of 100, 80% of 60, and 80% of 250, in total that's 328. So my balance sheet is not balanced. Why not? Well, because goodwill is missing, and I need to introduce, let me do this here, I need to introduce goodwill. And the goodwill was calculated before as 122. Okay, so that means here I delete 328, and here I delete 328, and we are good so far. So let me take these numbers out. So far we are good. Last step, I need to recognize non-controlling interest. Okay, and here, as I said, we take the values as of today and 20%. Okay, so 100, let me put this in brackets, 100 plus 168.75 plus 250 for the retained earnings, all this times 20%. That equals, how much is that? 103.75. Okay, and then we are done. Well, we are done. I eliminate the 20% of the 100 because I reallocate them to the non-controlling interest. Here, very important in net income, non-controlling interest, they get 20% of the total profit. So 20% of 168.25. Excuse me, it's a little bit confusing. There we go. Okay, and get also 20% of the total retained earnings. Therefore, retained earnings have been completely eliminated. My final capital, as always, is capital of the parent company. My net income, well, here we need to calculate, but in total it's 167. Okay, NCI is 103, and total liabilities is 560. So that in the end, my total balance sheet is 1,130.75. Okay, and we are good. Okay, so the tricky part here is in net income. No? Remember, I need to eliminate the pre-acquisition net income, which was 60, and I eliminate only my 80%. Obviously, I do not eliminate that for the non-controlling interest. Non-controlling interest, they don't care. The subsidiary made a profit of 168 for the full year, and non-controlling interest, they hold 20% of that profit. Remember, for the non-controlling interest, their situation has not changed. They were non-controlling before, at the beginning of the year. They are non-controlling at the end of the year. So for them, the whole year is exactly the same in terms of numbers. The only thing that has changed is the controlling shareholder, which is me. Okay. So therefore here I eliminate only my percentage of the pre-acquisition profit. Okay. And then we are good. And we have the final numbers in my consolidated balance sheet. Do you have questions, please? Someone is writing. No questions? Okay. Well, in that case, we are done with this. And we saw, therefore, the full consolidation method. So depending if you have more or less than 100%. And we switch to the next method, which is the equity method. So as a reminder, if I go back at the beginning, depending on the relationship between the parent company and the subsidiary, I control, and therefore I have a subsidiary that is fully consolidated, as we have seen. And then one notch below, so usually between 20 and 50% of voting rights, I have a significant influence. And that means the investee company is an associated company, and we apply the equity method. Okay, so now we are talking about the equity method. So let's do this here. Okay, so first of all, we could say that usually the equity method is presented when we talk about consolidated financial statements, although the equity method is not really a consolidation method. Because as you can see here, for example, there is no combined balance sheet. We do not add up assets, liabilities, revenues, and expenses. We don't do that. Okay, we do not eliminate all internal transactions, only transactions that impacted net income, for example. Okay, so in other words, the equity method is not really a consolidation method. It's more like an accounting method. However, we present this within the framework of consolidated financial statements because in many countries, the equity method is only allowed in consolidated financial statements. Not in all countries, but in many countries. And therefore, you will see the equity method only when you look at in consolidated financial statements. So if the equity method is not a consolidation method, what is it? Well, it is a type of revaluation method. Okay, so in other words, today I buy a stake in an associated company. So for example, 30% of another entity. And I have a purchase price of those 30%, whatever that amount is. And this is my starting point. And from there on, I will revalue my investment amount, which means the investment amount further can go up subsequently, or the book value of my investment can go down. I will revalue my investment in a way that follows the equity of the associate company. So in other words, if the equity, remember I own 30% of the associated company, if the equity of the associated company increases, I will account for 30% of this increase in my balance sheet. If the equity of the associated company decreases, I will account for 30% of the decrease in my own balance sheet. Okay, so that means it's a revaluation that is not based on market values. I'm not looking at the market value of my investment. I'm following the book value of my investment. Okay. Now, what are the reasons? I invest in a company today. What are the reasons why the equity of my investee company changes after my investment? What are reasons in general? What are reasons why equity changes, why equity goes up or why equity goes down? So that I need to revalue my investment. What are reasons for changes in equity? Any idea, please? Oh, no ideas? Well, okay. Ang Wu. Okay, so nobody has an idea. Oh, okay. Sorry, Tuido, I didn't see your your chat. I don't know why. Okay, so let me go back quickly to our case. Where are we? Here. So here your question is regarding the 80% of 60. But remember, that's what we need to do every time. So when I did the first acquisition, remember here, I did exactly the same thing. At the acquisition date, the net income was 60, and then I need to eliminate 80% of this profit. And that's something I need to do every year and all the time. So therefore, 9 months later, I will eliminate, we could say, the same 80% of 60. And I will do this every year. Okay. Now, going back to the equity method. So the stock price changes. Okay, that's a possibility. But remember here in the equity method, as I said, my revaluation is not based on the stock price. So here my question is, why does the book value of equity change? And well, mainly there are two reasons, let's say. Obviously, we can increase equity by issuing new shares, for example. Okay. Or I can decrease equity by deleting shares, canceling shares. That's also possible. So one possibility of increasing or decreasing equity is increase or decrease the number of shares. Well, this is not really captured by the equity method, because in that case, obviously, my percentage may also change. Because if I have 30% and now the associated company issues new shares, that means either I have to reinvest in the company to maintain my 30%. And well, if I reinvest, obviously my investment book value will increase, or my percentage decreases, and therefore I have to recalculate the new percentage, the lower percentage on the new equity value. So, and it's not sure how this works out. So increasing or decreasing the number of shares is one reason. And the second reason, more important here, is profits. Obviously, if the associated company makes a profit, equity goes up. If the associate company makes a loss, well, equity goes down. And in the equity method, since I revalue my investment based on this evolution, that means, well, if equity increases because of profits, I will account for my part, my share of those profits, 30%. And if equity decreases because of losses, I will account for my share of these losses, 30%. Okay. Now, something that we do in the equity method that is equal to, or the same thing in the full consolidation method, is we have to do a purchase price allocation. Okay, so that means even when I buy only 30% or less than 50% anyway, but more than 20, even when I buy that part, I need to do a purchase price allocation. That means I need to look for valuation differences, brand name, equipment, liability values, and so on. And I may identify a goodwill. So the purchase price allocation is the same. Obviously, we do this only with the acquired goodwill method, in a sense. We do not recognize any non-controlling interest. Why not? Well, because we are in a situation here where I am actually the non-controlling interest. Because I buy only 30% of the shares, that means, well, somebody else maybe has 70%. Okay, but everything is the same. And I will show you a little bit later how we present this in the balance sheet. Okay, let's do an example here for the equity method. So on December 31st of the first year N, parent company buys 40% of A shares for 60. Okay, my question, why do we pay 60 for those 40%? Not 70, not 50, but 60, and precisely 60. Yes, indeed. So here also we assume that we acquire the investment at book value. So 40% of the book value is 60. That means here I do my purchase price allocation, okay, but we do not have any information. That means here there is no valuation difference, there is no goodwill, there is none of this, okay? But I need to do a purchase price allocation. But here we assume, because there's no information, that nothing has happened, okay? Now, how do I consolidate? And once again, it's not really a consolidation method. That's why here I put the quotation marks. Actually, what we do is we take simply the balance sheet of the parent company and we revalue the investment. That's what we do. And I will rename this line item. Instead of just calling this investment, I will give a name to this line that tells readers that on this line and on this line only, we applied the equity method. So the name of this line is not standardized. So here, for example, in my slide, I call this investment in associate company. Okay, it could be called equity method investments, something else. Okay, but you will clearly see this, and on this line only, we use the equity method. Okay, so here, how do I need to revalue my investment? Well, not at all, because the acquisition is as of December 31st, so I'm already at the end of the year. That means between today and today, obviously, there is no change in value. That means here, well, in this first application of the equity method, there is nothing to do, because my equity method book value corresponds already at 40% of the equity. So therefore, we are good, and there's nothing to do. Okay, so far so good. So the only thing is rename the line item. Now we are 1 year later. Okay, so here is the balance sheet of the parent company. I still have the original investment. And this is the balance sheet of company A. And now we see that the equity of company A has increased and is now 180. That means for the book value of my equity investments, I need, or I want, a target value of 72. Because once again, the equity book value should be basically 40% of equity. So that is my target value. Okay, since my existing book value is 60, that means I need to add 12. So I will do plus 12 in the balance sheet to bring my book value up to 72. But if I put plus 12 on the asset side, I need to put plus 12 somewhere else, obviously, to balance my balance sheet. That means I need to analyze where this increase comes from. Okay, so once again, last year, equity was 150. Okay, now this year it is 30. Okay, so clearly there's an increase of 30 since the acquisition. Where do the 30 come from? Well, I tell you, the 30 here are based on profits that company A made. How can I be sure that the plus 30 here is not related to the fact that the company A issued new shares? Maybe that's why equity increased. I don't know. But I can tell you here, given the information on the slide, I can assure you that company A did not issue new shares. How can I say that? How can I prove that? Any idea? How do I know that the increase of equity is due to a profit and not due to the issuance of new shares by company A? Okay, yes, the ownership, my ownership stays at 40%. This is one element. That's correct. Okay, but maybe my ownership remains at 40% because company A issued new shares and I bought 40% of the new shares. You know, I can reinvest in company A to maintain my shareholdings or my percentage at 40%. Maybe that's what I did. But how do I know that I did not buy additional shares of A? Therefore, my stake remained at 40%. And again, I did not purchase additional shares. How do I know that? Well, I know that because my investment book value did not change. So I'm still having 60. If I had purchased additional shares, my investment book value would not be 60 anymore. It would be 60 plus the purchase price of the new shares. Okay, so here company A did not issue new shares. Okay, therefore the plus 30 is profit. So I will account for 40% of this profit because 40% of this profit belongs to me, which is 12. So I will put plus 12 on the asset side and I will put plus 12 in my own income statement. So I will immediately account for this profit in my own income statement in the same year. So if in 21 the associated company made a profit, I will account for 40% of this profit in my own income statement for the year 21. So in the same year. That, of course, is unusual because in general, as a shareholder, how do I retrieve the profits of my investment company and when do I account for them? In general, not in the equity method. No? I'm talking in general. How do we do this usually? How does an investor get profits out of his investment? How does an investor get a return on its investment? Okay, but now you're writing about the equity method. I'm saying outside the equity method in general. You are a shareholder, you're holding shares of a company. When do you get your profits and how? That's my question. Not in the equity method, in general. Well, I get my profits with the dividend payments. Okay, dividends. But dividends usually are paid with a time lag. That means the company makes a profit in 2021. Well, the dividends will be paid usually if we have annual dividends. The dividends will be paid in 22. That means accounting-wise, I can account for the profit of my investment only when I receive the dividends in 22. And that means here we make an exception to this rule within the equity method, because the profit now appears in my own income statement at the same time as it does in the income statement of the associated company. So they're making a profit in 21, and in parallel, in the same year, the same profit, well, my share of the same profit will appear in my own income statement. Okay, that's N1. Now we are in N2, and now the equity is 200. Okay. And what it is based on? Well, there's a total increase of 50 since the acquisition date. 20 relates to the net income of the second year or the third year, N plus 2. And 30 is an increase in retained earnings. So in other words, we assume that all the profits that I had last year, plus 30, all the profits were retained. No? Doesn't really matter what we assume here, but here we assume everything has been retained. Okay, so here I see the 200. Okay, as a target book value, I want to see 40% of the 200, which is 80. Okay, which means my original book value, I need to increase it by 20. So plus 20 on the asset side. But in my own equity, obviously, I need to make a distinction where the increase comes from. For 20, we said the increase is related to net income of N plus 2. Well, here I did the same thing I did in N plus 1. I will account for my share of the net income, which is basically 8. And therefore, I will put plus 8 in my own income statement. 30 of the increase was related to an increase of retained earnings. So I account 40% of that in my own retained earnings. 40% of 30 is 12. So I do plus 12 in retained earnings. So plus 20 on the asset side, plus 20 in equity, but on two different lines. And maybe there could be a third line. Now, for example, maybe the increase in equity is related to an increase in other comprehensive income, OCI. Well, then the same thing, I would account for 40% of the OCI increase in my own OCI. Okay. Questions on the equity method? So you see, it's relatively simple. I follow on the asset side my percentage of the book value, and the according changes go in equity, either net income, my income statement, or retained earnings, or other comprehensive income. So let's have a look at the balance sheet and income statement of Air France to see where this is. Well, not here, obviously, but a little bit later. Here we are. So in the consolidated balance sheet, see here we have a line investment in equity associates. So that's what the name they chose. And that means here now I can see that on this line and on this line only, Air France used the equity method. Now, I said before that even in the equity method, we need to do a purchase price allocation. That means identify a goodwill, check out for brand name and all of this. So we do the same thing as in the full consolidation, but in terms of presentation of this goodwill or the brand name, there's a difference. Because if my equity investment includes a goodwill, this goodwill will be included in this book value. Okay, so any equity method goodwill or brand name or everything is included in the same line. It is not included in this goodwill here. This goodwill here shows only goodwills that are related to a full consolidation, only related to subsidiaries. Same thing, a brand name that is part of intangible assets, that's only brand names related to subsidiaries. There are no brand names included here that relate to equity method investments. Okay, so in the equity method, I do a purchase price allocation, but everything is included in this one line, okay, in the single line. Therefore, sometimes, or in the old times, let's say, the equity method was sometimes called the one-line consolidation, because you have a consolidated approach, but everything happens just on one line. Okay, so that's what I see in the balance sheet. And in the income statement, I will also see the equity method changes. So remember, we account for, in my own net income, I account for profits and losses related to the equity investments. And I see this also on a specific line in the income statement. And here you go. It's presented at the bottom, and it's share of associates. Okay, so that means here I see my associated companies made a loss. I account for whatever 40% of this loss, and this is 58. Well, it was a loss of 58 in 2021, 20, and a gain of 23 million in 2019. Okay, so there is a specific line in the balance sheet that I see with a specific name, and there is a specific line also in the income statement. Okay, so far. Here we have another example that is very much known. Renault, well, the French car manufacturer, holds 40% of Nissan. Okay, therefore Nissan is an associated company, and you see here they call this investments in associates and joint ventures. So therefore we know that on this line we apply the equity method, and here they show us Nissan as a separate item. You see that this investment makes roughly 10% of the balance sheet of Renault. So therefore it's very important, and they show this individually. We see also that the book value has heavily decreased compared to last year. So what does this tell us? If I see I have my equity method investment and the book value decreased very heavily, what type of information does this give me? Anyone? Well, that tells me that Nissan is in bad shape. Because why does equity decrease? Because of losses. And here, remember, my book value goes down by 5 billion, and this is only 40%. Yes, indeed, Kintran, there is a loss. So that's only my share of the loss. In the income statement, I see that. So here they have share net income of associates and joint ventures. And I see indeed, well, there was a 5 billion loss. That means the total loss is actually much higher because that's only my 40% of the loss. So that means in 2020, Nissan made a huge loss, and I account immediately for 40% of this loss. Whereas in 2019, they made a small profit, and I accounted for 40% of this profit. Okay, that means actually with the equity method, you see here, just by looking at the two numbers in the balance sheet, the income statement, I can see indirectly how the associated company is doing. Is it doing fine or is it doing badly? I can see that here. But obviously, what I cannot see in the equity method is in detail. What are the reasons why Nissan is not performing well? For example, I don't see if this is maybe just a one-time thing because of COVID, or they have lasting problems, because I don't see anything what's going on in Nissan. And that's why the equity method actually was the very first type of consolidation that was applied, one-line consolidation. But since this does not give enough information to see what's going on in subsidiaries, the consolidation method for subsidiary has been invented. And now I can see indirectly in the consolidated balance sheet and income statement, I can see everything that's happening, not just on one line. And the one line method, equity method, was maintained for less important investments. So investments that are only between 20 and 50%. Okay, that's the idea here. And therefore we are done with the equity method. If you have no more further questions on that, please. Okay, apparently not. Then let's finish the second part by talking about step acquisition. Step acquisition is a situation where, contrary to the previous examples here that we saw, where we do not buy 60% immediately, but we increase that. But actually, sorry, I forgot something before we do this, because there's a case that we can do on the equity method. It's exercise number 4. So what I propose you is that I give you 15 minutes to do the exercise number 4, the equity method, the A and the B part. Okay. And then we discuss the solutions. And since it's also break time, we will combine all this. Okay, so I give you 15 minutes to do the case. That should take you until 4 o'clock approximately. And then we do 30 minutes a break, which means that we will meet again in 45 minutes. In other words, at what time is that for you? At 4:30. Okay, is this okay for you? So 15 minutes to do exercise number 4, and then 30 minutes break after that. Okay, thank you. Then I see you again at 4:30. So you were supposed to work on exercise number 4, where the parent company acquired 25% of company A for 40. And that means we have a significant influence, and we have the two balance sheets of the two companies. So we see that the equity of company A at the date of acquisition is 160. We buy 25% of this. 25% of 160 is 40. That means here our purchase price allocation leads to the fact that we do not have a goodwill or other valuation difference. Okay. So prepare the consolidated balance sheet at the date of acquisition. Well, here's my investment book value, and since we at the date of acquisition, obviously nothing has changed since the date of acquisition. That means here, well, my book value corresponds already to my equity book value. Okay, so therefore the only thing I need to do eventually, or certainly, is I need to reappraise my investment and, for example, call it equity method investment in order to see make the difference. Okay, and that's it. But the amount is already correct. Okay, so far so good. And here we are actually 1 year and 9 months later. So it's not at the end of this year, it's at the end of the following year. Okay, so what do I need to do? Well, first of all, I need once again to change the name of my investment and call it equity method investment, for example. And then I need to calculate the target value. Okay, so now one year and 9 months later, I have a new equity, of course, and we see here the equity now is capital, retained earnings, and net income. Okay, so in total, we have 100 plus 180 plus 150. Okay, and I own 40% of this company. Well, sorry, 25% times 25%. Much is that? Well, we have 300, 430. 25% is 107.5. If I check with my solution to be sure, yes. Okay, so this should be my target book value. Okay, 25% of the equity at the date I use the equity method. Okay, since right now my book value is 40, that means I need to add a total of 67.5 in order to get to the higher amount, which is my target, 107.5. Okay, so I need to add 67.5 here. That means I need to analyze where the increase comes from. So I compare the balance sheet at the date of acquisition and equity today. So we see the capital is the same. Obviously, in n plus 1, I have net income of 150. And since I own 25% of this company, I get 25% of the net income. Okay, so that means I have the net income of the parent company, and I add 25% of the net income of the subsidiary, which is actually, calculate this, 37.5. Okay, that means, well, my final profit in the end is 137.5. Okay, and then I see here we have retained earnings of 180, and we did not have any retained earnings at the date of acquisition. Okay, however, I have to remember in my accounting system, of course, that at the date of acquisition, there was a profit of 60. And if I have retained earnings today, 1 year and a half later, or 1 year and 9 months later, obviously, this net income is still in retained earnings. That means my retained earnings increased actually from, or increased to 180 today, but at the acquisition date, I assume there was already a profit of 60. That means there's a change of 120 in my retained earnings, and I get 25% of those 120. 25% of 120 is 30. That means here I will increase my retained earnings by 30, so that my final retained earnings are 90. Okay, and this would be my second accounting entry. Okay. All right, so plus 67.5 on the asset side, plus 30 in retained earnings, plus 37.5 in profit. And that's how we do the equity method. And in case of a loss, etc., obviously I would act accordingly. Okay, very good. Any questions here, please? Relating to the equity method. No question. Okay. Very good. Then indeed we finish the consolidation part, the second part, by looking at step acquisition. Okay, so as I mentioned a little bit earlier, not all acquisitions, when I take control, for example, are done in one step. So I do not necessarily buy 80% right away. Maybe I start with a small investment and then over time I increase the investment, and then one day I get to an 80% stake in the company. So that's called a step acquisition, where over time we build up our investment. How do I account for this? So, for example, I start by buying 15% of a company. Okay, well, 15% investment is nothing, so it's not significant influence, it's not control, it's not joint control. That means here we simply have a financial asset. And that means I use fair value through profit and loss or fair value through OCI. I will explain this right after this chapter, because in the next chapter we talk about accounting for financial instruments, financial assets. And this is simply a financial asset, so no consolidation whatsoever. Then I buy another 25%. That means now, after doing this, obviously I reach a total investment of 40%. If I add up the two, 40% means, well, it's now an associated company and I use the equity method with 40%. The question is, how do I measure the first 15% before using the equity method? So here, because obviously I have the purchase price of the 25% today, and I use that as a starting point, and from here on I apply the equity method. Question is, what do I do with the older book value of the other 15%? So in IFRS, there is no clear rule. So either we could do the same thing that the Americans do, means a retrospective application of the equity method. That means today when I have the 40%, I check out what would have been the book value if I had applied the equity method since the very beginning, starting with 15% and accounting for 15% of the profit and retained earnings and all this. And today I buy another 25%, and that would be my starting point to use the equity method from here on with 40%. Okay, that's first possibility. Or a second possibility, I use the fair value. Okay, so not the book value, I use the fair value. Well, actually, the fair value is already indicated here. That means I just continue with the book value, actually. Okay, that's the two possibilities. And again, in IFRS, it's not regulated. Okay, then I buy another 25%, and that means now we have a total of 65%. That means 65% is more than 50, and that means with this last acquisition of 25%, actually I took control. Now the investee company is a subsidiary and I need to consolidate. But remember, in consolidation, we have the investment book value that is cancelled and that I compare also in order to calculate goodwill and do the purchase price allocation, that I compare with what I buy for. So it's the same thing. What do I do with the 40% that I held previously? Well, the 40% are fair valued. Okay, so remember, as of now, the 40%, we use the equity method because we are at the end of step B. Okay, now I need to fair value them. Fair value is not the equity method book value. Fair value, as we'll see later, may be market value. And any gain and loss that comes from this revaluation is considered as a profit. So you could say it's the idea below is it's as if I sold the 40%, okay, and I would sell it for the fair value today, and any difference between the fair value and the equity book value would be a profit or a loss that goes in the income statement. And I reinvest in the same 40%. So I buy them, so to speak, at today's fair value, and that would be 40% fair value today plus 25% fair value today, because that's what I actually pay, equals 65% of fair value today, and that would be my investment book value, the one that I use in the consolidation process. So here we have an example when British American Tobacco bought Reynolds, the American company, several years ago. And you see an interesting thing, because you see here that the profit actually of the year is higher than even the sales revenue. How is that possible? Well, it's possible because of this line, share of results of associates and joint ventures, because actually British American Tobacco owned already some shares in Reynolds and they revalued them. Okay, and that generated a revaluation gain of 24 billion pounds. Because here we're talking about 24 billion pounds, and they were shown as a profit. Okay. All right. And then lastly, I have 65%, and now I buy another 10%. So that means now I own a total of 75%. However, going from 65 to 75% is not a big deal. Why not? Well, because there is no change in status. I controlled the company before with 65, now I control with 75. Well, control is control. So it doesn't really change my consolidation procedure at all anyway. So there's no new goodwill calculation, no nothing. But what changes obviously is the non-controlling interest. Because here I have 35% controlling interest. Now there's only 25% controlling interest. That means actually this is a transaction where I buy non-controlling interest. And that means it's an equity transaction, because non-controlling interest is part of equity. So it means basically I buy or I pay out some shareholders. And what happens? Well, my cash position will decrease because I pay them money, and non-controlling interest will decrease in equity. And that's about it. Okay. That's a step acquisition where I ramp up over time my stake in the company. Any questions? Not so far. Okay. Then we see what happens when it goes the other way around, reduction in ownership. So here I start with 80% that I own today, and now I sell 20% of those. That means I go from 80 to 60. Well, that's a similar story. There's no change in status. I still control the subsidiary. I controlled it with 80 before, now it's 60, but doesn't change fundamentally anything. So no recalculation of goodwill, nothing. And it means basically before I had 20% non-controlling interest, now I have 40% non-controlling interest. So I increase non-controlling interest. Non-controlling interest is part of equity. So it's like creating new equity. So my cash position increases because I sell my stake, and in equity, non-controlling interest increase because now the NCI people own 40% of my company. So it's not a big deal. Then I sell another 25%, and that means now we change the status because I go from 60 down to 35%. With 35%, the investee company is only an associated company now, and we use the equity method. That's the same thing. Okay, I sell the 25%, but when you're selling something at a certain price, you make a profit or a loss. So how do you determine this profit or loss? Well, the retained interest, that means the 35% is fair value today, and I take the fair value of today and the selling price minus the book value of what I had of the total investment. And any difference of that is my sales profit or selling gain or loss upon sale of the 25% stake. Okay, then I sell another 30%. That means I go from 30%, 35% down to 5%. Well, with 5%, my investment is nothing special. It's just a financial asset. And therefore, I need to use, once again, accounting rules for, how do you say, for regular financial instruments. So nothing special, and financial instruments are always fair valued. Okay, potentially on those two sales, B and C, I may also apply IFRS 5 if it's a sale that is actually planned. IFRS 5 deals with assets held for sale or discontinued operations. Remember, we spoke about this the first or the second day. Discontinued operations. So discontinued operations are planned sales. So if I plan to sell the 25%, then maybe I have to apply IFRS number 5, which changes obviously the accounting. I will not go in detail here to do that, but we need to reclassify the investment. It's not an equity method investment anymore or a financial asset. I need to reclassify this and change my valuation or measurement methods. Okay, that's it on consolidation. All right, so we did everything, and the last step of consolidation is present the consolidated numbers, balance sheet, income statement, cash flow statement. Well, that's what we saw in the very first part, how to present this information. Okay, that's it on consolidation. Do you have any questions, please, before we move on to the next chapter? Any general question on consolidation, equity method, anything you want to know? Is no comments? Okay. Then we continue and look at financial instruments. So what we've seen so far is how do I deal with an investment of more than 50%? Well, it's a subsidiary and we consolidate. Maybe it's a joint venture and I may use the equity method. Maybe it's an associated company and we use the equity method if I'm between 20 and 50%. And basically, if I'm below 20%, so we don't have any of those situations, then we just have a regular investment or other investments. And here we need to apply the accounting rules for financial instruments, in particular IFRS number 9. Okay, so how does this work? So first we talk, or let's put it this way, here we talk about financial assets first, okay? Only for assets. Well, in IFRS number 9, actually there are 3 or 4, it depends on how you see things, 3 or 4 measurement categories. So actually I have to make a distinction on the asset side of my balance sheet for financial investments, financial assets. How do I value them? Okay, and there are 3 valuation methods or 4. The first one is fair value through profit or loss. Okay. The second one is amortized cost. And the third one is fair value through OCI. You see, that's the same, except that for some financial assets, we do recycling of OCI. For other financial assets, we do not do recycling. But basically, the measurement method is the same. So fair value through profit and loss, amortized cost, and fair value through OCI. Okay. Now, the next question is, before a little bit later I explain to you what fair value actually means, how do I decide, who and how do we decide if I use fair value or if I use amortized cost? Okay, well, there's a question maybe coming up. Tuido question? No, I don't know. Okay. Well, recycling, I will explain a little bit later. When I explain in detail how the method works, then I will tell you what recycling is. And indeed, it depends on the company's strategy, more or less. But it's a little bit more complex. Here's the decision tree. First of all, I need to make a distinction. Again, we talk about financial assets, okay? And first, I need to make a distinction if we are talking about a debt-tied asset or if we talk about an equity investment. Okay, so it's not the same decision tree. So here first we talk about a debt financial asset. That means a bond that I purchase, but it also includes, for example, accounts receivable, because accounts receivable are a financial instrument, and it's a debt because well, your client needs to reimburse you. Okay, so accounts receivable are also in this decision tree. So first of all, for my debt instrument, I need to verify if it is SPPI or not. SPPI means solely principal and interest. That means the question here is my financial instrument, is it a simple instrument or is it a complex instrument? Because SPPI, solely principal and interest, means here we talk about the debt instrument where the only thing that happens and that is contractual is that the client pays the interest and that the client reimburses the original amount. So we would say that's like a regular bond or an accounts receivable, because the client pays the receivable, there's no interest is zero, but the client pays the accounts receivable and then we are good. So the instrument can be SPPI, that means it is simple, or it is not SPPI, which means it is complex. What is a complex financial instrument? Well, for example, you buy a bond, okay, and it's in euro, and the bond is in euro, everything is in euro, the interest is in euro, and so on. But the interest rate, for example, is fixed every 6 months, and the interest rate is fixed based on the currency exchange rate between the dollar and the Japanese yen, according to some formula. Okay, that clearly means it's not a simple financial instrument, because you can imagine now how to value the bond. That's quite complex. And we introduce something else than the credit risk here in the bond. Usually in a bond, you only have a credit risk, more or less, and maybe an interest rate risk. Okay, but here I include a currency feature that has nothing to do with the bond. That means if I have this type of bond, it is not SPPI, it is not simple, it is complex. And basically, it involves or includes a derivative financial instrument. And since that's the case, well, for any instrument, any debt instrument that is not SPPI, okay, I use as a valuation method fair value through profit and loss. And that is driven, or this decision is driven by the fact that the bond includes a derivative financial instrument, and derivatives are always measured as fair value through profit and loss. Okay, so anything that is not SPPI, we will go for debt instruments that will go in fair value through profit and loss. Okay, just maybe before we continue, a quick remark. Now it's 5 o'clock for you, but obviously we have to catch up the fact that there was a problem in the planning. So that means I will continue another 25 minutes or so until 5:30. And tomorrow, now I have the new hours. Tomorrow we'll do it from 4 to 5. Okay, so I will continue now. Okay, so first decision, is my instrument simple or complex? And by the way, for simple instrument, we also say they are plain vanilla. So if the instrument is simple and is SPPI, yes, then I need to do a second test. Talking about what Tuido said, the strategy, well, it's called the business model. In other words, why did I buy this debt instrument? Why did I make this debt investment? And there's different reasons. First reason may be that I want to hold the debt instrument to collect the contractual cash flows, which means basically I will hold the debt instrument until maturity. Remember, we're talking about debt, so there is a maturity. I hold the instrument until maturity. And I want to cash in the interest payments and I want to cash in the reimbursement, and that's it. And once the debt instrument reaches maturity, okay, it's all done and all gone. So for example, my accounts receivable typically are in this category, because your accounts receivable, well, you wait 2, 3, 4 months, depending on the delay of payment, you wait that your client pays you. Okay, and that clearly means you hold the receivable to collect the contractual cash flows. Second possibility of a business model, you hold the instrument to collect cash flows, but also to sell potentially. So as of now, you did not make the decision yet to sell it, but it is a possibility. That means, well, I will keep it now, and then I will see in 1 year, in 2 years, in 5 years, maybe I will sell it. Maybe I will not sell it and keep it, but there's a possibility of sale. So that's something that we have, for example, in cash reserves. You know, we do cash management, and that means we may buy some short-term bonds, and I hold the bonds as long as I don't need cash. But obviously tomorrow or the next week, I could sell the bonds in order to raise money because I need to pay some bills. Okay. So that would be hold to collect and to sell potentially. In this case, the valuation method is fair value through OCI. And again, I will go more in detail later on how this works, and with recycling. And again, I explain that later. The third type of business model that's possible, it's everything else, and that includes speculation or trading, for example. So if I do trading, all right, well, trading would be in this in this last category. So speculative financial assets are always in the category fair value through profit or loss. Okay, so first we do the SPPI test. Secondly, we check the business model. Based on this, we have either amortized cost fair value through OCI or fair value through profit and loss. Questions on that? And by the way, I do those tests, so the SPPI test and the business model test, I do this when I acquire the financial instrument. Okay, so I will not do this at every balance sheet date. I do this only once at acquisition. Okay, any questions on that? Apparently not. Okay, so this is for debt instruments. What happens for equity instruments? Here it's a little bit easier. So remember in the beginning we said, for example, we buy less than 20% of equity of another company. Here it's a little bit easier because all equity financial assets, equity investments that are not consolidated and not in the equity method, I use fair value through profit or loss. Okay, so that's the default measurement category. However, there is an exception because companies can also use fair value through OCI for non-trading. That means basically strategic investments. Okay. So why this option? Well, in the beginning, the regulator said, no, all equity investments should always be fair valued. That means we have basically a market value because that's the best measurement option. And all fair value gains and losses should go in the income statement because that leads to higher transparency. But there was a lot of resistance against this type of accounting. Why? Well, indeed, sometimes companies do hold strategic investments over a very long time. And the purpose of those investments is not to be sold on financial markets. And well, but more to create like a strategic link in the long run. Well, if the purpose is not to sell it, why should I use a market value all the time and put all market value changes in my income statement, which obviously leads to some volatility. And therefore, after negotiations, lobbying, and so on, they decided to say, okay, we keep the fair value, but we put the fair value changes in OCI, and therefore you have less volatility directly in the income statement. The only thing that hits the income statement here are dividend payments that I may receive. Okay, so for equity investments, it's rather simple because it's fair value through profit and loss, and if not, fair value through OCI. And then we are good. Okay, that means it's either fair value through profit and loss or amortized cost. Amortized cost can only be applied for debt instruments, okay? And I have fair value through OCI as a third category that can be applied for certain debt instrument and that is optional for certain equity instruments, sometimes with recycling and for equity investments without recycling. Okay, so 3 measurement methods basically and several conditions when you can or must apply them. Yeah. Okay, let's see here what we have. For example, we have a listed bond that is SPPI of company A, and the intention is to hold the bond until maturity. So which measurement method do you think applies? Amortized cost, fair value through OCI, or fair value through profit and loss? Anyone, please? Amortized cost, fair value through profit and loss, or something else? Anyone, please? Any idea? Okay, well, it's a bond. All right, so that means we need to check. Well, is the bond SPPI? Well, yes, because it says so. Then we need to check the business model. And the business model is to hold the bond for the next 4 years until maturity. That means the business model is hold to collect contractual cash flows. Well, that means the bond goes in the category amortized cost. That's what I have here. Okay. Then we have the second one, still a bond of the B company, SPPI, that the company FI intends to resell very quickly. So it's an SPPI bond, all right? That means I need to check the business model. But here the business model is not to hold to maturity or to collect the contractual cash flows. The business model is not collect cash flows or sell. The business model is only sell. That means here we have a trading or speculative. Well, sorry, Tudo, it's speculative. We want to sell very quickly. Therefore, it is fair value through profit and loss. Here, the intention is not to collect any contractual cash flows. It's rather fast. Then I have a call option for US dollars. Can anyone tell me what the call option is? You know that? Call option on US dollars. What is a call option? The derivative, yes, that is correct. But what can I do with this option? Call option. What can I do? Yes, indeed. Gives me the right to buy US dollars. That's why it's a US dollar call option. Exactly, that's correct. Now, what is my measurement category? Well, as I said earlier, it's a derivative. Derivatives are always measured, sorry, at fair value through profit and loss. Okay, by definition. Number 4, I have 10% of listed shares of the C company for which we have no specific intention. So here we're talking about an equity investment. Okay, what is the measurement method that I need to use? Amortized cost, fair value through OCI, or fair value through profit and loss. Any ideas? Fair value through profit and loss. Yes, is possible. Yes, possible. But is it mandatory to use fair value through profit and loss? Not necessarily. I have also the fair value through OCI option. So here, fair value to profit and loss is the default category. I could use the option because here I have no specific intention. That means it could be a strategic investment. It's not for trading, otherwise the intention would be clear. So it's a longer term. That means potentially it's OCI. Okay. And finally, I have cash in foreign currency that is held by the company. Well, cash is always in the category fair value through profit and loss. So it means here in foreign currency, that means I need to translate my cash in the local currency, and any fair value gain or loss that I have based on this would go in my income statement directly. Okay, so very important, I need to apply my decision tree for debt investments. For equity investment, it's a little bit easier, and based on that, upon investment, I classify my financial assets in one of those measurement categories. Okay, so far so good. Now let's talk about fair value accounting, because indeed we have fair value through profit and loss, we have fair value through OCI, and therefore what does it mean fair value? Well, because we don't use the term market value, we use fair value, and that means there may be, and actually there is, a difference. So we have a separate accounting standard, IFRS number 13, actually a whole accounting standard who tells you how to define and how to calculate the fair value. And you see the fair value definition here. It's a price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So basically, since here we talk about financial assets, the fair value is a potential selling price of the asset. Okay. And obviously, in our mind, when I say fair value, I mean, or I understand mostly a market value. And therefore, indeed, if there is a market value for my financial instrument, I should use that market value. And therefore, the fair value is my market value. Okay. However, although here we talk about financial assets, financial instruments, actually for a majority, a large majority of financial instruments, there is no market. Okay. So just to give you an example, in the European Union, and I think it is similar in Vietnam, you know that better than me, but in the European Union, for example, if you look at shares and market price for shares, in the European Union, we have roughly 8,000 listed companies, and listed mostly with shares. So 8,000 listed shares. But we have millions and millions of stock corporations. And that means there are millions and millions of shares that are not listed. And I think it's the same in Vietnam. I don't know how many companies are listed in the on the stock exchanges, Hanoi, Ho Chi Minh, in Vietnam, but we can assume that there are many, many more stock corporations in Vietnam. That means I have a large majority of shares in Vietnam and in the European Union that are not listed. Okay, so large majority of shares are not listed, no market value. For bonds, if we look at worldwide bond market or debt markets, it's the same thing. You know, if you think about all accounts receivable, there is no market value. There is no market value. Even if you look at bonds issued by companies, well, there are some of them are listed, but many, many of them are not listed at all. They're issued privately, you know, like an insurance company or an individual investor or a bank buying the bonds directly. There is no market value. No? And even for derivative financial instruments, so options, futures, swaps, and so on, well, only a very small percentage are listed. Most of derivatives are OTC. Do you know what OTC means? So OTC derivatives or OTC financial instruments. What does OTC mean? Over the counter, that is correct. Which means basically they are tailor-made. They are not standardized. It's a one-on-one transaction. So I go to the bank, I need a currency option or a future, for example, to manage my risk. Well, we will negotiate the details of the derivative directly with the bank. So that's an OTC derivative. Most derivatives in the world are OTC. So they're not standardized. They are unique products. That means there is no market for them, and hence there is no market value. So in other words, for the large majority of financial instruments, there is no market. That means I cannot use the market value as a fair value. And since I cannot use it, I need to use another value. I need to use a level 2 or 3 fair value. So we have a hierarchy of fair values. Level 1 is market value. If that exists, I need to take it. If it doesn't exist, which is the case in the majority of situations, I need to use a level 2 or 3 value. So what is level 2 or 3? It means I mark to model. So I will use a valuation model that is generally used for this type of financial instrument. So for example, to value a bond, we use the DCF method, discounted cash flow. That means here I have my individual bond. Well, I will do the same thing. Options, to value options, for example, I could use the Black-Scholes formula. Okay, so here I have an option that is OTC. I will use the Black-Scholes formula. Now, that means I use a model that is widely used in the market to value this type of financial asset. And then I need parameters, obviously, variables to put in my model. If I can observe those variables in the market, then I should do this, and we talk about the level 2 fair value. If I cannot observe those parameters in the market, then I have a level 3. So level 3 means basically I have my Excel sheet, I have a formula to use it, but the variables I put in my formula are determined by myself. Whereas on level 2, the variables are taken off the market. That means here you can see that from level 1 to 3, we have a certain degree of objectivity. Remember, faithful presentation, relevance, I need objective values. The market value is the most objective one, and therefore if there is one, I should take it. If that doesn't exist, I take a model value, but a model value with market input. So that's relatively objective or relatively subjective, as you want. And if that even doesn't exist, then I need to take a model with my own values. And you see that level 3 obviously is not objective at all, or very, very thinly objective. That means the quality of fair values is decreasing, is degrading from level 1 to level 3. Level 1 is the highest fair value quality. Level 3 is the lowest fair value quality. Okay, until 2008, 2009, the big financial crisis, we had already this fair value hierarchy, but companies were not obliged to publish to what extent they did use level 1, 2, or 3. They just said we used a fair value, but didn't tell you which one. Now, since 2009 and the financial crisis, it is now mandatory to use and to indicate in the financial report the fair value hierarchy that you use. Let me see here for Air France, where we have the table somewhere. Although I need to search for it a little bit. Obviously, it's an airline, so it's not very important. See here the different levels, and here we have a table. So in the notes, they give us a table to what extent they did use level 1, 2, or 3. Okay, so what do we observe? You see that for equity investments, most of them are in level 2, so they are listed. But for debt instruments, you see that the biggest chunk, actually at least in 2019, is in level 2. And you see also that Air France has nothing in level 3. No financial instrument in level 3. Why not? Well, because it has a very bad reputation. So level 3 financial instruments are in a minority now because it has a bad reputation. Why? Well, because of the latest financial crisis. Because most of the subprime instruments at that point, they were level 3. So very bad reputation. That means today what we can observe is that most financial instruments actually will be in level 2. Okay, why? Well, because level 1 does not so much exist. So the majority will be in level 2. Companies will minimize level 3. Sometimes it's not avoidable. Okay, so you have some level 3, but you try to minimize that. And level 1 usually is somewhere in between. Okay, because there's not so much market values out there. Okay, that's the fair value hierarchy that we have here. Any questions on that, please? So very important, in accounting, we use fair value as a terminology, not market value, even if underlying, obviously, we suppose that we are talking about market values, but actually that's only the case in the minority of situations. Okay. No questions. Well, then let's see how this fair value accounting works. So once again, we can have fair value through profit and loss, or we can have fair value through OCI. Let's start with fair value through profit and loss. Well, that's rather easy because it means that today I buy the asset, so I have the acquisition cost at the first balance sheet value, and from there on, I fair value my instrument. And the fair value goes up, the fair value goes down. All of this is accounted for, and all fair value changes go directly in profit and loss, which means go directly in my income statement. And then we are done. Okay, then let's make an example on this for fair value through profit and loss. Okay, on June 1, I buy some money market funds for the purpose of short-term profit. I buy 2,000 funds today for 100. That's the purchase price. And at the end of the year, at the balance sheet date, the market value, or more precisely, the fair value of those funds has increased to 109. Okay, so what are my accounting entries. How do I do that? Okay. So first I buy on June 1st, sorry, I buy 2,000 of those funds for 100. That means I buy a current financial asset. Remember, it's for short-term profit, so it's current, for 200,000 in total. And there will be a cash outflow of 200,000, assuming I pay cash. Okay, so minus 200 in cash, plus 200 in financial assets on the balance sheet. At the end of the year, the fair value of my money market funds has increased to 109. That means at the end of the year, my portfolio value now is 218,000. 2,000 funds valued at 109. So total portfolio value is 218. That means in the balance sheet at the end of the year, I need to increase the value by 18. Okay, and now I see on the asset side of my balance sheet 218,000, okay, as total value. And that means also there's a value gain of 18,000. This value gain goes directly in my income statement as a profit or as a revenue. And therefore here I generate plus 18 in profits. If my portfolio value or the value of my money market funds had decreased, then obviously I would decrease my balance sheet value and I would recognize immediately an expense in my income statement because I made a loss. So either way, and by the way, that's it, fair value through profit and loss. Okay, at every balance sheet date, I fair value my asset and the value goes up and down. Any increase or decrease goes directly in the income statement. And then we are done. So remember at the very beginning, we spoke about other comprehensive income and OCI and fair value accounting. So here we see the advantages of fair value accounting, but also the inconvenience. Okay, what are the advantages of this type of fair value accounting? Well, first of all, on the asset side of the balance sheet, I see the true value of my portfolio as of today. My portfolio value today is 218, not something else. And therefore, I see this fair value on the balance sheet. So that's good. The balance sheet gives me the right information. I see also in my income statement that during the year I made a profit of 18. In other words, I made a good investment decision because I invested in things that over time gained value. So there's a value increase and I see this profit, I see this gain in my income statement. So that means also the income statement gives me the right information. And that's positive because faithful representation of the economic situation, well, people want to see what happened during the year, and here I do see it. Okay, these are the pros of this fair value through profit and loss. What are the cons? What are the inconvenience? Well, first of all, here we are talking about the profit that is not realized. And it's a profit that is based not on a sale, but on fair value accounting. And maybe my fair value is not the market value. That means here I may have a subjective asset value and I may have included a subjective profit in my income statement. It's not objective in a sense that it's based on a transaction. It's only on paper. That is not so good. And from a managerial perspective, another con is the fact that fair value through profit and loss accounting induces volatility. Okay, because now my income statement, my profit in the income statement jumps up and down following the financial markets. So the volatility of financial markets, if I assume it's a market value here, the volatility of financial markets actually is introduced in my income statement. And as a manager, I don't like volatility. As an investor, I don't like volatility. That means now this volatility is incorporated in my financial statements. That makes it much harder as my CFO job to steer the company to a targeted profit and it makes it harder for investors to see where the company is going, actually. So volatility is a con here with this type of investment. But you could say, well, if you don't like volatility, don't operate on financial markets. Okay, nobody forces you to buy money market funds. You could use something else that is not subject to volatility, that is not subject to financial market volatility. But if you do make this decision to engage in this type of activity, then okay, well, you're subject to volatility. And then maybe it's better that I see the volatility instead that you are hiding this from me. Okay. So volatility is a con, okay, but it depends on how you see things actually. Okay, so fair value through profit and loss basically applies to speculative financial instruments or derivative financial instruments, not to anything else basically, and some equity investments, of course. Okay, any question on fair value accounting? Well, fair value through profit and loss so far. If not, we are done for the day. And I meet you again tomorrow morning, well, for me and for you at 2 p.m. in the afternoon. Are there any final questions, please? Well, that doesn't seem to be the case. And well, that means we are done for the day. So thank you very much. And I